Let's get back to Jacob Mitchell, who's the CIO of Antipodes, and of course Paul Donovan's with us as well. Right, you strayed onto Korea in our previous conversation, but you do like a couple of names there as well. Tell me why one of your top picks, and I'm just looking down at the valuation, is Hyundai, which trades at a discount to the broader market, 9.3 times forward, but at a premium to the main names we see in Europe. And we're going to talk about Volkswagen later on. So what do you like about Hyundai?
Hyundai's got a good exposure to emerging markets. It's number 2 market share in markets like India. It's below trend if you look at EM auto sales. They lag developed markets. You could argue there's a decent catch-up cycle to happen in places like Brazil, Russia, India, and the China exposure has certainly been slow to recover, but I think that's another sort of opportunity. Also, if you think about just the corporate structure of Hyundai, it's highly inefficient in the sense that there's stakes in Kia, there's a lot of cash on the balance sheet, a lot of property on the balance sheet. So that PE doesn't really capture all of the surplus assets. Mm-hmm. So we think there's definitely an opportunity for better capital management. And the largest shareholder outside of the family shareholding is the National Pension Scheme of Korea.
So are you taking, and excuse my ignorance for not knowing, but do you take a particularly activist stance on trying to get them to change that level of cash held on books and indeed that corporate structure and indeed those stakes in Kia? So are you on the aggressive side when it comes to banging on the door of the boardroom?
We're not an activist. That's not our skill set. We describe our approach as constructivist, so we ultimately, in our investment case, we'll anchor a lot to just what we see going on in terms of product cycle, changes in competitive dynamics that are favourable or not favourable for a short. But certainly management is a part of that, and if management can be seen or the board has a natural path to better capital allocation policy, we can, we'll engage in a constructive way to encourage them in that direction.
Can I ask you more broadly about South Korea, because it's quite a fascinating allocation. You have the same allocation to that country as to the US, and you've pointed out a couple of different factors around corporate governance, which I thought was extraordinary, because we saw the Samsung case, which raised some hopes that you would see a pushback against some of the corruption problems in the background, the dominance by very wealthy families. But I think there are question marks for a lot of people whether anything's actually changed.
Absolutely, I think that's a justifiable view. We wouldn't be hopeful that all of a sudden people's principles change without very strong commercial reasons for them to change. And it's not the families that are going to change. I think it's the behaviour of the National Pension Scheme. The NPS is the pension scheme for all Korean workers. It owns roughly 7% of the entire Korean stock market. And similar to the GPIF in Japan, they're under significant pressure to generate income. Korea is one of the oldest societies, one of the most rapidly aging societies in the world. And in this low interest rate environment, the opportunity for dividends and growth in dividends will be a lot of their future returns.
Paul, are you worried about efficient capital allocation on balance sheets as well? I mention this because Jacob talked about this in terms of the companies he's looking at as well. And I and Jeffrey, before we had the pleasure of Karen's company as our co-anchor, we used to hear this phrase a lot in 2006. Oh, your balance sheet isn't efficient enough. You need to gear up more. You need more leverage, you need less capital on the books. And I quite like a company that's Lord Weinstock-like, that keeps a little bit in reserve. Do you have concerns about the gearing up of balance sheets around the world at the moment?
So if we look at overall corporate debt, in the US or in Europe, we haven't had a huge increase in corporate debt in recent years across the economy as a whole. That does not say that certain sectors or the pressure of shareholders in certain markets hasn't led to increased leverage. But you look at the overall debt ratios, they haven't exploded, not least because companies aren't lending to other companies, banks haven't been lending for the last few years. I think there's an interesting question as we look ahead about how companies look to invest, how capital is going to be handled in the future. The things like IT consumerization that we've been seeing, where you bring your own device to work and you basically subsidize the company by providing your own capital equipment, self-employment, working from home. I mean, this is changing the relationship of capital and the company in a pretty significant way. In the last 10 years, e-commerce in the United States has gone from 10% of business-to-business transactions to over 70% of business-to-business transactions, and yet the share of capital that is spent on IT equipment and software has gone down every year for the last 10 years. Why? Because you're getting the staff to bring their own capital. So this, I think, is actually the more interesting thing about the future, is how do we change the relationship between companies and capital?
Fantastic. A nice place to leave it. Jacob, thank you very much indeed for joining us today. It's been a real pleasure meeting you. Jacob Mitchell, the CIO of Antipodes, to join us here at Round the Set.